Has anyone ever told you, I just make so much money while I'm asleep? If you've ever heard anything like that and you're trying to figure out exactly what's going on, this video is for you. For those of you who are new here, my name is Nathan Mohan. I used to work in advising businesses on how to allocate their finances. And during my time, I learned that while people were really good at allocating businesses' finances, they weren't as good at the personal finance side. And so I wanted to share. Let's get into it. So there's a really short answer for how people are making money when they're asleep, and that's by investing. Investing is a process where you either put in time, energy, or dollars in order to grow money. And as that money grows, you obviously get financial rewards. The key to investing is, especially when it's financial investment, aka dollars to grow dollars, able to make money simply by being asleep. In this video today, we are going to talk about what investing is and why people invest, how investments make money, and common forms of investment so that you all have an idea of how to actually start making money. So we've already covered a bit of what investing is. The reason why you invest is, say I have $100 and it's just sitting in my bank account. 10 years from now, that $100 is still going to be $100. Nothing has grown. However, if I invest, even if my money is growing at, say, 5% a year, what you end up seeing is in those same 10 years, the amount of money I have made has grown substantially. It's not even comparable. And the beauty of this is it takes as much effort to save and put that money in cash or in a bank account versus making an investment. And that's entirely what people do it. Now, with that being said, how do investments make money? The most common way you see investments make money is you will buy an investment, usually in this case called a financial asset, at a certain point in time. That financial asset will grow in value over time. And so say I bought it for $100. 5 years from now, it becomes $300. Over those 5 years, my investment has given me $200 of profit. That's way number one. Way number two is usually you are paid back because you have an ownership interest. So this can take many different forms and honestly is probably less significant than the value increasing of a financial asset. But some examples of this include if I own a company and the company is giving back profits, aka dollars that they don't have to spend anywhere else, I view that as a financial benefit of an investment. Another one is if you give a loan to someone and they have to pay back that loan with interest, that interest is an ownership interest. And so as a result, you're making money that way. With that being said, there are a couple of caveats here to how the money is made. Remember, there is always a risk to investing. For example, if I buy a financial asset and that asset ends up going down in value, that's an issue. I've actually lost money. Similarly, if I make a loan to someone and I think I'm going to get interest back as part of my ownership of that loan, and they end up not being able to pay me back, that money is just gone. I am not getting my interest, nor am I getting my initial investment. With that being said, with smart investing, you are usually able to come out. Let's talk about the primary ways with which people invest their money. The first way people invest their money, and the one that is most common, is in the stock market. The stock market is a collection of companies that make their ownership available to purchase. So what I mean by that is if I buy Amazon stock, I own a very, 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 very small part of Amazon. Now, those stocks go up in value as the company does better. And so as a company turns more and more profit, that profit is given usually to the ownership, aka investors. And so as a result, The profit of the company going up usually means my share price goes up. And so if I buy a share of Amazon, for example, and the profits are climbing, after a certain period of time, I can sell that share for more than I had before. That being said, the second way people invest is in the bond market. Bonds are a little bit different. Bonds are basically just loans. Bonds can come in different flavors and forms, but the most common bonds that you'll hear about or you'll see are treasury bonds. These are bonds that are basically loans to the US government. And so you purchase one of these bonds and it'll pay you interest over time, and eventually it'll pay back your principal. Principal is the initial money that you loan to the government. Another type of bond that you'll see commonly is a corporate bond. Similar to you loaning money to the government, there's also a mechanism with which one can loan to a private company. So let's use Amazon, for example. Say Amazon is building a new data center somewhere and they need money to build that data center up. They can take a loan and build that data center and pay you back interest and eventually pay you back the principal after a certain number of years. The final loan type that you'll see is a municipal loan, often called a muni bond. A muni is very similar to a government bond, but it is focused on state and local governments. And so the nuance with a municipal bond is basically it'll be for a project in your own community. For example, if I want to see a new school being built, oftentimes you will see funds being raised via a muni school. The big way that bonds usually make money is via interest, as I've been alluding to. And so you put out that loan and you see interest dollars come back. The third market that you will see people commonly invest in is real estate. Real estate is land and houses. And so basically it is where people live and where you can put buildings and factories. The way real estate works and the way people most commonly invest in it is by houses. Real estate is unique versus some of the other markets. Namely, when people buy real estate, more often than not, they are taking a loan to purchase the underlying real estate. Now, what this ends up doing is you're able to buy a home that is worth way, way, way more than the actual dollars you are putting out to acquire. Say, for example, you were buying a $500,000 home. Oftentimes, you can get away with just putting down $100,000 or less to buy a house. And so it's a way to achieve wealth over time. As you pay off that loan, that real estate becomes more and more into your name. Analogously, if the price of the real estate goes up, you're able to then sell that real estate and capture more money because you had put in less cash up front. The way that looks, for example, is using that same $100,000. The value of the home is $500,000. I only put in $100,000. And so the next year, if the price of the home goes up to $600,000, and I sell it, I capture $100,000 of profit because I only have to pay back $400,000 to the bank. The final market that people have been looking at more and more is cryptocurrencies. Cryptocurrencies are digital currencies that you can use to buy and sell goods online, but more commonly, they're just used as an investment. Because you can see if cryptocurrencies go up a lot, you end up making a lot of money. Cryptocurrencies in general are more difficult to predict versus other markets and tend to swing much more with them. And so you'll see cryptocurrencies swing from, for example, Bitcoin, $20,000 to $100,000, swing up and then come back down. And so that in and of itself makes it an interesting opportunity for investment. There's a few other asset classes that we haven't covered here, which are more accessible to high net worth investors, which includes private equity, which includes hedge funds, but that gives you a basic primer for the types of investments that you can go and look at. With that being said, y'all, in the next video, we're going to be continuing to tackle some of the nuances of investing across these different asset classes. Stay tuned.